Well, welcome to our macro day at the CSAE conference. It's a pleasure to welcome you all here this afternoon. This session, the first of three macro sessions, is on fiscal policy, debt and adjustment. We have three papers rather than the originally scheduled four. Unfortunately, one of our speakers has had to withdraw at the very last minute, but we've got three excellent presentations to follow. And I will try and maintain the same format as initially anticipated. So each presenter will present for 15 minutes, and then we'll open it up for Q&A. And I will pass the microphone to our first speaker, who's Ignacio Campomanes from the University of Navarra, who's going to speak about foreign aid and fiscal policy. He will be followed by Bernard Njiri from Stellenbosch in South Africa, talking about financial openness and external adjustment in emerging markets. And our third speaker will be Andrea Presbitero from Johns Hopkins in Washington, DC, talking about borrowing costs after debt relief. So without further ado, let me stop sharing my screen and I will pass the microphone and the screen to Ignacio. So Ignacio, welcome. And once you're set up, we'll start the clock on your 15 minutes. We'll give you a brief reminder when you're about 5 minutes from being.
Okay, perfect. Thank you very much, Christopher. I think you can see my screen now and hear me well. So thank you very much for giving me this opportunity to present this paper on foreign aid and fiscal policy. It's a very early work in progress, so any feedback and comments and critiques are very welcome. So let's see. Okay. So the motivation of the paper is the goal and the emphasis of many international organizations in the last few years and decades in promoting domestic revenue mobilization. So the idea is that a government with sufficient resources to provide productive public goods and services is a necessary condition for economic development. Now the question is, can foreign aid solve this lack of domestic revenue? Or at least can it help in raise this revenue to give more productive public goods? Now the answer that has been analyzed earlier in the literature, or at least part of the answer, is that it's going to depend on the fiscal response of the recipient government. And as I said, there has been some potential mechanisms and channels analyzed previously in the literature. Let me just review some of them briefly. One of them is a potential crowding out effect, right? The recipient government receives an inflow of aid and then decreases his tax effort for political reasons, because taxing citizens is always unpopular. So maybe they just substitute the previously domestic tax with foreign aid. So at the end, aggregate resources of the government are the same. A related problem is the so-called Samaritan's dilemma, which says that maybe the recipient government is going to reduce its development effort just to secure future aid flows. Okay. Another potential channel is that problem of fungibility. So maybe aid that is intended to promote some growth promoting activities and investments is diverted to some other uses by the government, maybe current consumption or just transfers that are not growth promoting. And at the end of the day, aid is going to be ineffective in its ultimate goal of promoting economic growth. And finally, there is a literature on the relationship between foreign aid and democracy. And the risk that maybe a government that is receiving a lot of funds from foreign donors are going to answer and respond to their needs and whatever these donors want instead of what their citizens might need. Okay, so my paper is related to this literature, and what it does is just to build a very simple theoretical model that tries to capture two important and I think relevant characteristics of least developed countries. Okay, the first one is that they have usually an important informal economy. So they are characterized by a dual economy with a formal sector and informal sector. And these, if we think about government revenue, clearly limits the capacity of the government to raise taxes if a lot of people are working in the informal sector, which activities are not easily observable and taxable. Then a second important characteristic, I think, that also is very relevant for African countries is the distinction between a benevolent government and self-interested government. To what extent the recipient government responds and follows policies intended to increase the utility of their citizens, or if they are trying to, or at least partially, maximize their own utility, their own rents or their own political rents. Okay. So as a preview of the results, what I do is set up a model with these two specific characteristics and then think about what happens when they receive an inflow of aid from outside. Okay. When the government is benevolent and they care exclusively about the citizens' utility, then aid is going to be effective in terms of increasing public investment, welfare, and growth. And this is going to be so irrespective of the way aid is structured, if it's unconditional aid or if it's aid tied to investment projects or other kinds of aid. Now, the problem is when the government is self-interested, okay? Then now aid is going to be effective only in some cases, depending on how aid is structured. In particular, if aid is unconditional or tied to investment projects, aid is not going to be effective in this setting. Okay, at the end, aid is just going to go to increase political rents, and it's not going to change public investment, formal sector activities, and economic growth. But within this framework, there is a way in which you can structure aid so that it incentivizes the government, even though they want to maximize their own utility, but they do so by promoting and incentivizing formal work if aid is structured in a way that it actually makes the government do so. So it can be effective even if self-interested governments are receiving these flows. Okay, so let me very briefly sketch the model. So there are a continuum of identically and infinitely lived households that have access to two different production technologies. Okay, they can work in the formal sector. This sector is going to use public capital, denoted by G, and formal labor to produce an homogeneous good. And then the technology in this sector is potentially different from that of the informal sector. Okay, and here I want to capture different ideas that have been brought by the literature. Like, for example, if you're working in the formal sector, then you have access to financial intermediation that might make production more efficient, or some other channels. Now, the second sector in which individuals can work is the shadow or informal sector. And this sector is different from the formal sector, first, in the fact that it doesn't use public capital. It only uses labor. And second, also the productivity parameter that might be different, as I said, and usually you should think as the shadow productivity being lower than the formal sector productivity. And there is another difference between the two sectors, and is that the government can only observe production in the formal sector, okay, and can only tax the income and the production in the formal sector. I'm going to assume that production in the informal sector is completely unobservable and thus cannot be taxed. So individuals are going to solve a very simple problem of dividing their time endowment between the formal and informal activities. Okay, and they're going to maximize their consumption in each period, the lifetime consumption, discounting the future by beta. And everything, the utility function is standard, increasing, concave, etc. Now the government is going to do two things. They're going to impose a linear tax on formal income, denoted by tau, and then they're going to use the government revenue to invest in public capital, denoted by G. Okay, so at the end, the government budget constraint that has to be satisfied in every period is total tax revenue coming from formal production, finances, public investment, net of depreciation, and XT, which are the political rents that I was talking about before. Okay, so for now, just think about XT as something exogenous, is some cost that the government has to finance. Okay, when I make the government self-interested, this is going to be endogenous. The government is going to decide how much of the total revenue they want to allocate to themselves. Okay, so a definition of a competitive equilibrium in this setting is very simple, it's very standard. It's just an allocation and tax policies such that, given the initial public capital and political rents that are exogenous, the consumer solves this problem. As I said, is just allocating their time endowment between formal and informal labor, and the government budget constraint is satisfied. Now we can solve this consumer's problem, and the first order condition gives me the optimal allocation of labor between formal and informal activities. And as would be expected, the time allocated to the formal sector is increasing in public capital, because it's going to make marginal product of labor in that sector higher, is increasing in the ratio of formal to informal activities, and is decreasing in the tax rate, okay? Now, given this condition and the government budget constraint, we can find all the sequences of taxes and investment in public capital that constitute a competitive equilibrium. Okay, now let's think about optimal fiscal policy. What's the best policy that the government can do to maximize the citizens' utility? Well, the definition is standard again. The Ramsey equilibrium is the same as the competitive equilibrium, but now the government not only has to satisfy the budget constraint, but chooses policies to maximize welfare of the citizens. Okay. As I said, for now, I'm assuming that political rents are exogenous. If I endogenize them now, when the government is benevolent, then the government would obviously choose XT equals 0 because they want to maximize the citizens' utility. But I make it exogenous just to make a judicious comparison with the self-interested case. Okay. So the only difference I do in solving this Ramsey problem from the standard literature and standard Ramsey tradition is to solve the problem in terms of policies instead of in terms of allocation, as is the usual procedure. Okay, so I introduce the optimal allocation of labor from the consumer's problem, and then solve for the optimal tax and public investment for the Ramsey government. Okay. Now, taking the first order conditions and assuming that there is a steady state in the long run, so productivity in two sectors and the rents of the politician converge to a constant level, then these two equations are going to solve the optimal Ramsey problem. It can be shown that the derivative of the tax rate with respect to the political rents is increasing, and the derivative of the public investment with respect to political rents is decreasing. And this is helpful because now when I think about foreign aid, at the end of the day, in this case, an influx of aid is going to be the same as a decrease in political rents, right? So just think of foreign aid as a sequence of unconditional, well, of funds, sorry, that the recipient government can use freely, right? And for simplicity, just think that is the same amount in every period. Now, the only change here, especially when we think about unconditional aid, just like pure grant flows, there are lump sum, and the government can do whatever they want with them. It's not going to affect the marginal choices of the Ramsey government, right? So it only enters in the government budget constraint, and it's just equivalent to a decrease in political rents. So the effect of this kind of aid on a benevolent government is just going to increase public capital and decrease the tax rate. And these two things make formal sector more attractive for individuals. It's going to encourage formal sector activities, and that's what make aid effective in promoting welfare and output. Okay. The same happens when aid is not unconditional, but tied to investment projects. So you have to.
Can I just remind you, you've got 5 minutes to go.
Okay, perfect. Thank you. Okay, so in the case of tied aid, this is very similar to the unconditional aid case. Okay, the only difference, you're supposed to use the aid only for investment. You cannot decrease taxes, but as long as aid is not too large compared to initial domestic investment, the result is going to be exactly the same. Now let's think about the self-interested case. Now the government, instead of maximizing the citizen's utility, is going to maximize his own utility that I denote by G. Okay, and his utility depends on the tax rate that he keeps for himself from the government budget. Okay, so the problem that the self-interested government solves is this maximization of his utility subject to the budget constraint, taking into account that the individuals are going to act optimally, so that he takes into account the optimal decision on labor from the individuals. Okay. Now, how does aid affect this case? Well, in the case of unconditional aid, again, it does not affect marginal choices. Okay, so at the end of the day, aid is just going to go directly to the politicians' pockets in the forms of political rents, and it's not going to change public investment nor taxation, nor aggregate formal labor. So at the end of the day, aid is going to be completely ineffective in this case. if aid is tied to domestic public investment, again, as long as aid is not too large, not larger than the initial domestic investment, the result is the same as in the unconditional aid case. If aid is very large, then you can have some partially effective effects of aid, because at the end of the day, the self-interested government can only reduce its own investment up to zero. So if F is even larger than that, aggregate investment is going to be larger than initially, than without the aid, and growth is going to increase a little bit, or at least help it. Now, there is a way in which you can think of it, how to structure aid in order to make it effective, which is to tie it to domestic revenue. So you can think of the donor saying, I'm going to give you 20 cents for each dollar that you raise domestically through taxes. That's going to make the self-interested government, even if he looks for himself, he wants to promote formal activities, because then he can raise more taxes and receive this extra aid. So aid would show up here in the government budget constraint, and it would affect these marginal choices, making the self-interested government want to increase public investment, decrease taxes, and make at least the aid flows partially effective. Okay, so just to conclude, the policy implications of this simple model is that first you have to take into account the specific characteristics of least developed countries when thinking about aid effectiveness. The second one is you have to think about the specific way you disperse and structure aid flows to the recipient government. And then just my ideas for further research is first, I'm thinking about introducing limited commitments. So the government is not only self-interested, but also lacks commitment. So that's going to also introduce this component of thinking about the timing of aid. Maybe if the government is self-interested and lacks commitment, then you want to backload aid as much as possible in order to keep the government from deviating. I want to introduce private capital and see how these private capital and public capital are complements in production or substitute, and think about the relationship there. And then I would like to think about what the data say about these kind of predictions. It's true that there is a large literature on cross-country regressions that has some problems. I'm thinking also about analyzing episodes of large aid inflows, okay, and try to think about those and see to what extent variables move in the way the model predicts. And this is my presentation. I think I'm good on time.
Perfect. Thank you very much, Ignacio. That was excellent. So there's quite a lot to digest there for the audience. An exciting but challenging theoretical model. Please feel free to ask any questions that come to mind. Think about these presentations as we go forward. We will come to the questions in the Q&A after our third presentation. So at the moment, I'm just going to move straight to Bernard, and we'll have his presentation followed by Andrea. So Bernard, the floor is yours. If you can share your slides, and it is, you've got until essentially 15-17 minutes or so for presentation. We'll give you a warning when you're about 5 minutes out. Okay.
Okay. Okay, thank you and welcome to my presentation. My name is Bernard. I'm a PhD candidate at Stellenbosch University in South Africa. My research is on financial openness and external adjustment in emerging and frontier economies. And I know the classification of economies as emerging or frontier is a complex and endless debate in economics. But for simplicity, I take emerging economies as those economies with an income of upper middle. That's according to the World Bank classification. And frontier economies, I take those ones with an income level of lower middle income. And now why is it interesting to look at emerging and frontier economies? For the last decade, emerging and frontier economies have eased capital control regulations. They have integrated with the global financial markets. And over time, like I show in figure 1, there is a growth in risky assets in emerging and frontier economies. And these economies are also becoming more vulnerable externally as they are running huge current account deficits. Although the economies seem to be building policy buffers through exchange reserves. And now I got the problem statement. My model is built following 2 studies. One is by Gorinchas and Lee and Clarida and Magarin. Gorinchas and Lee derived a balance of payment identity that explains how return on investments and net trade affect the current account. And Clarida went ahead to specify how these 2 channels can act. That is the financial channel of exchange rate and the financial channel through the interest rate mechanism and the financial channel through the exchange rate mechanism. That's now what Clarida brings in a theoretical framework. And Clarida shows how the 2 mechanisms work. But the gap in these 2 studies, one is that they have not captured how capital controls and lead exchange rate adjustment can affect external adjustment. And the second one is that they do not address macroeconomic implications and welfare cost of capital control in emerging and frontier economies. And the motivation of this study comes from a study by Edwards in 2004, where he pointed out that emerging and frontier economies, especially in sub-Saharan Africa, are prone to sudden stops and current account reversals, and this poses a challenge to an economy that is opening financially, because in case there is a reversal and the withdrawal of foreign capital is massive, it causes instability in the financial system. And this study contributes to the literature by developing a model with a funding technology that can capture financial openness and sudden stops. And also it analyzes the relative importance of channels of external adjustment in economies with different degrees of financial openness. And I would like first to summarize my findings. The first one is that capital control, when capital control is relaxed and exchange rate is allowed to adjust, trade channel is amplified and foreign flows rise, hence an increase in foreign risk premium. The other one is that foreign funding interest rate shock, when we relax capital control and we allow real exchange rate to adjust, real exchange depreciates, trade balance improves, current account improves, and foreign risk premium falls. And with the high capital control and adjusting exchange rate, real exchange drives the trade balance, current account, and foreign flows. And for the welfare analysis, loss is low when capital control is high in emerging and frontier economies. In my model, the household makes a decision on consumption, savings, and borrowing, and the household has no access to international international financial markets. And this makes sense because households in developing economies are not active in the international financial market. In my domestic production, look, I have a technology shock. I have a technology production that is called Douglas, and equation number 6 is key to my model because it introduces a constraint that is binding to the farms, and this constraint introduces a distortion in the market. We will see how, because of that constraint, different sectors are affected or respond differently when we adjust capital controls. And this is now the funding technology I was talking about, where we have two funding inputs for the domestic banks, that is domestic deposits and foreign deposits. We have a deposit branch that packages deposits and then gives the deposits to their own branch that has a binding binding balance sheet constraint number 10 when it's now giving loans to households and farms. And the cost of lending to the households is the difference of the loan branch, the cost of getting loans, deposits from the loan branch, and the interest rate charged on households and farms. I have 3 shocks. The first one is the foreign interest rate shock. I have the technology shock, and the third one, I also have a government spending shock. And the 3 shocks are AR1 processes, and that's an assumption. In my parameters, I'm mostly interested in 2 parameters that I have circled with a dotted line. And the first parameter, alpha B, captures the degree of financial openness, which is also a parameter that is regulating capital control. The second parameter, eta, when I set parameter eta to 0, it means I only have one channel, that is the interest rate channel, or the interest rate mechanism. That is the one that is driving the model. If I set parameter eta is equal to 1, I allow exchange rate and interest rate to interact. And that is the approach that is taken by Clarida, where you allow the 2 mechanisms to interact so that we can see how the trade channel and the financial channel interact. I now go to my results. The first, I start by presenting a response to technology shock. So when we the red line shows an economy that has high capital control, or an economy that is less open. And in this case, I set eta is equal to 1. That means 2 channels are operating. If I allow 2 channels to operate, let's concentrate on the trade balance in the current account. And also, I will concentrate on credit to the tradable and non-tradable sector. So when we allow the 2 channels to operate with a high capital control, that is the red line, and when we allow 2 channels to operate with alpha beta is equal to 0.5, that means we have relaxed capital control. We realize that with high capital control, farms increase their capital. Farms increase their capital, but this adjustment in labor is falling. That means they are substituting capital. They are substituting capital with labor because capital is increasing while labor is decreasing. In the non-tradable credit and the tradable credit, the tradable sector is not affected by this capital control, but the non-tradable sector is affected more by the capital control. And this is also reflected with the household credit. But foreign risk premium is not affected, and foreign exchange rate is not affected when we adjust capital control. In the second case,
you've got about 5 minutes to go, Bernard.
Okay. In the second case, I retain only one channel. I set eta is equal to 0. In this case, when I set eta is equal to 0, we see that the interest rate channel, when we impose high capital control, leads to a current account expansion. Trade is also expanding, and exchange rate is depreciating. And again, the two sectors respond differently to this adjustment. And the other channel is response to foreign interest rate shock. Again, when we change the degree of financial openness or capital control, and we allow either one channel or two channels to operate, we can see through capital, trade balance, and current account, and also the tradable and non-tradable credit, that the responses of these variables are different across sectors. And when I include now both channels and now I include government, the role of government, when with high capital control, that is the black line, with high capital control, firms are employing less capital and less labor. But when we increase capital control, when we ease capital control by setting alpha B is equal to 0.5, firms employ more capital and labor. Again, the tradable and non-tradable sector respond differently to this adjustment. And for the welfare analysis, in this case, welfare is the sum of the variances. Our results suggest that welfare loss is lower when there is high capital control. And this welfare loss is computed from output, consumption, bank funding, real exchange rate, and trade balance. And again, I tried to compare the model, the business cycle statistics I got from my previous paper to the theoretical movements that I get from this model. And we can see that output, the theoretical movements of this model can closely predict output, trade balance as a ratio of GDP, and it can also closely predict foreign debt as a ratio of GDP. In conclusion, we see that trade channel and financial channel offset each other because the two channels were moving in opposite directions. And the other one is that adjustment increases when we increase or when we change the degree of financial openness. And the other one is that the impact on sectors is different when we change capital control. My recommendation is that high capital control for emerging economies, emerging and frontier economies is good because it results to low welfare loss. And for the model stability, the model can be applied in emerging and frontier economies with different levels of financial integration or financial openness and resource intensity. That's my presentation for today. Thank you.
Thank you very much, Bernard. That was excellent. So again, let me encourage any questions to be posted to the Q&A box, and we'll come to them shortly. In the meantime, can I turn to Andrea? Very nice to see you, Andrea. Welcome, and you have 15 minutes or so on borrowing costs after sovereign debt relief.
Okay, thank you very much, Chris. I'm happy to be back at CSAE, although I'm not in Oxford, and hopefully next year we will see in person. So it's a joint work with Valentin Lang and David Mihaly, and we are looking at sovereign debt relief, and especially the debt suspension initiative put together by the G20 over the last year. And we look at the effect on sovereign borrowing cost for countries which were eligible for the SSI. So the motivation is straightforward. Like COVID-19 hit in the context of existing debt vulnerabilities for low-income countries, and then made things worse and increased the risk of what has been called the deadly debt crisis. Under the debt service suspension initiative, countries which are eligible can ask to their bilateral lenders to defer debt service payment by 3 years. And this implies that all these countries can enjoy like a sort of an injection of liquidity, which is non-trivial in dollar amount. It's around $12 billion. And that is about 1/5 of the fiscal shortfall due to the COVID-19 shock. So it's sort of the liquidity injection is quite sizable. That said, many of the eligible countries so far, I guess until now is about 40% or so of them have not yet joined officially the DSSI, so are not taking this debt suspension initiative. And this seemed to us like sort of a passive response to what at first sight can seem like free money at times a great need. So we want to try to understand what are the reasons behind the low take-up rate of the DSSI, and we want to understand which could be the effect of the DSSI on sovereign borrowing spread, because if there are some sort of negative effect and spreads going to rise, it may explain the reluctance of participation in the initiative. So the research question is we want to look at potential spillover effect of one official form of debt relief, which is NPV neutral, on private bond markets. So theoretically, as I said, it's not clear which could be the effect of the DSSI on sovereign bonds. There are different mechanisms at play. So first of all, like in a frictionless setting, in a model without any friction, the DSSI is simply a postpone of that payment from what is due in the end of 2020 to some time in the future. So it's NPV neutral. And so without any, if there is no friction, there will be no effect whatsoever on sovereign borrowing spreads. However, well, you can also think that if the moment countries decide to join the initiative, so because I will discuss that in a moment, but countries are eligible, but then they have to make some sort of an effort to declare themselves as sort of participating into the initiative. If they do that, they signal that they can signal existing debt vulnerabilities. And on top of that, it's true that the NPV of external debt doesn't change, but their profiling of that service changes. And so that can also create some sort of future debt sustainability problem. If this is the case, then spread should increase, and that could explain why some countries do not participate in the DSSI. On the other hand, you can also think that liquidity provision could be actually helpful, can restore market confidence, can actually reduce the risk of the distress if you think that this is a liquidity crisis, and so liquidity can help countries weathering the shock and exiting the shock with better condition than without the DSSI. If this is the case, then spreads should fall. So given that the theoretical predictions are a bit all over the place, what we do here, we look at the data and we exploit the fact that the DSSI activation is a plausible exogenous shock. And this is kind of not frequent in this literature when clearly when you look at debt restructuring, they're always endogenous. In this case, instead we have a decision to restructure that in response to a global pandemic that has nothing to do with the fiscal and economic condition of these countries. And we do that using synthetic control method to be the counterfactual, to look at the, and then using that, we look at the evolution of daily sovereign bond spreads in the countries which are treated and in their synthetic control, which are our counterfactual. And then we can look if there is any difference around the policies between the countries and the synthetic controls. Very briefly, the policy design. As I said, the DSSI provides a 3-year suspension of principal and interest payment due between May 1st and December 31st, 2020 to bilateral official lenders. So it's an official debt relief. As a caveat, the DSSI has been renewed for 2021. There has been other discussion about changing the framework for sovereign debt restructuring. We don't do that. We don't deal with that for a number of reasons. First of all, there's a lot of confounding factors. We just look at the first round of the DSSI because in that case, it's truly exogenous. The DSSI targets 73 countries which are eligible, and those countries are countries which are under the IDA list of the World Bank, so are countries that borrow at concessional terms from the World Bank. And there are also countries that are in the LDC list of the United Nations. For that reason, even the eligibility criteria are set ex ante, because these lists are set before the shock. And they're somewhat heterogeneous with respect to access to financing and income levels. Also, eligibility is not conditional on immediate financing needs and debt repayment problems. So this is basically a response to the pandemic, and all these countries are eligible. It's not a problem of having already that problems of good or bad fiscal condition and good or bad access to finance. So it's truly exogenous to sort of initial macro condition of the countries. On the downside, the initiative comes with some condition. First and foremost, a request of IMF financing, which could be a key confounder of our results, and we deal with that explicitly. There are other conditions, especially using the fiscal space coming from liquidity injection to tackle the crisis. And third, to disclose information on public debt. Oh, sorry. So our data, we have daily data on sovereign bond spreads from January 2019 to August 2020 for 68 countries which are eligible, from 68 low and middle income countries, and this data comes from Bloomberg. Our sample includes 16 countries which are eligible from the DSSI and 52 which are not eligible, and so these are our donor pool. A key issue here, if you remember, I told you that the DSSI targets 73 countries. We have data on sovereign bond spread for 16 out of those, because most of the countries which are eligible for the DSSI don't have market access. And few have market access, but we don't have data on sovereign bonds. So you may be worried that there is a selection bias on the 16 out of the 73. We are aware of that. In the paper, we do sort of a balanced table where we show that the 16 countries with sovereign spread data are statistically similar to the other countries which are DSSI eligible but don't have sovereign spread data along a number of observables like debt, current account, income levels, and even the size of the COVID shock. Then we have macro data from the IMF World Economic Outlook and the data on the size of the DSSI debt service count from World Bank. So this is pure the sort of descriptive statistic of how the data look like. Here we have the sovereign bond spread for the 16 DSSI eligible countries and for the 52 countries in our donor pool. We simply take the median on the two countries, in the two group of countries, we normalize at 1 in April 2020, and you can see that they behave more or less the same in a very similar way. There is this huge increase in spreads when people in the market realized that there was the COVID was a pandemic. Then they plateau around April and May, and then they go down after that, and they go down more or less the same way. So from here, it seemed that the DSSI has no effect whatsoever, but here we are basically do a comparison between apples and pears, and what we want to do, we want to compare apple and apples, and that's why we do synthetic control. How we do our identification. So, as I said, the DSSI allow us to construct plausible counterfactual because it's somewhat exogenous, different from any other situation in which you want to study a debt restructuring. The DSSI has been announced simultaneously for all eligible countries and has not been tailored to individual country needs. The eligibility criteria, as I said, are based on pre-existing income thresholds. And we have some statistics, also some chart in the paper that also show that basically, if you want to look at the other side, there's very poor targeting. So the size of the DSSI is completely orthogonal to the size of the fiscal shock, the economic shock, the health shock in terms of COVID deaths and cases. Also, that our treatment date is May 1st, which is the date in which the DSSI becomes effective and coincide with the first country, Pakistan, that participation into the initiative. The announcement was on April 15. We can do our results on April 15. They go through, but we think that the treatment is really, there was a lot of uncertainty. If you look what was happening at the time, it was not clear if the countries were buying in the initiative. The moment the first country, especially a large one like Pakistan, buys in, then all the others join. So for us, the treatment is May 1st. The research design is based on synthetic control. We do a lot of placebos in the standard synthetic control to do inference. And then for inference, we also use more recent and sophisticated techniques, especially synthetic diff and diff and the generalized synthetic control, which in a nutshell, they combine the diff and diff with synthetic control and allow us to basically have a panel of countries and do a diff and diff on that panel of countries. In that case, we can control for time fixed effect and country fixed effect. So everything which is country specific and unobservables can be washed out. And then we also look at the mechanism, try to look at some sort of heterogeneous response to the DSSI in the most standard diff and diff framework. So the synthetic control, in a nutshell, generate a weighted average of the countries in the donor pool that match as close as possible treated countries in the pre-treatment period. Our donor pool is made by uneligible low and middle income countries. We built for each treated countries a counterfactual, projected the outcome of synthetic control into the post-treatment period using the pre-treatment weights. The synthetic diff and diff, as I said, is a combination of this counterfactual. You basically build a panel, you do a diff and diff in that panel, and you can have unit and time fixed effect. How we do the matching the synthetic control? We match in the pre-treatment characteristics using macro variable, standard macro variable, which generally predicts sovereign debt distress, GDP growth, public debt over GDP, the fiscal balance, and the current account balance. We also match on sovereign spread on 4 specific dates in the pre-treatment period. And we specify in the paper those dates, and we also do robustness around that. And also on the daily number of new COVID cases per million people to also try to match around the size of the pandemic shock. There are 2 assumptions here which are important for our identification. First of all, no anticipation. So the matching variable should not anticipate the event. And given that the event is truly exogenous, we believe that this is sort of a reasonable assumption. The other one is no interference, meaning that the donor pool should not be affected by the events. We know that there's a lot of global shock and spillover effect from sovereign spread, but in a nutshell, the literature tells us that the spillover effect from sovereign spreads are very strong among richer economies and from global factors, let's say the US to emerging markets. Here, our treated group are very poor countries, so it's very plausible to assume that it's very difficult to have spillover effect from what's happening on sort of sovereign spreads in low-income countries to sovereign spread in our donor pool, which is made mostly by emerging markets. Our results is our key charts.
Andrea, you have about 5 minutes to go.
Let's go. So this is our key charts. This is the takeaway of the paper. Here, each line is each of the 16 countries, and we plot the spread gap. So the gap between the actual spread of the country and this synthetic control. As you can see here, nothing happened, and the red line is the average of the 16. You see here, nothing on average happens before our treatment, the DSSI activation. After that, the dots are when the countries sign up and so participate in the initiative. This is Pakistan here, the first one. Then you have the other. You see on average, spreads goes down over the summer by something around 300 basis points or so on average. What is nice is that for all countries, spreads goes down compared to the counterfactual, for some more than for others. For no one, the difference, the spread gap is actually positive. There is a decline in spread with different intensities across countries, but on average, it's negative. So this is basically our paper. We do a lot of robustness. We do like drop some key countries, and we do different matching, and it's okay. We do everything around the announcement, same results, so it doesn't change if we take the announcement as our treatment. So how we do interference? Falsification test. First of all, we backdate the treatment in March 1st. There is no anticipation effect whatsoever. The average is flat, is equally split up and down, and then spread goes down over the summer. We backdate to 1 year before, just to see that our model works also in normal times and not only around the SSI. Again, nothing before, nothing after. There is one country which at the time was problematic, if I'm correct, is Zambia, but all the other are behaving perfectly fine. You don't see anything. In space placebo, we treat 16 countries which are just above the threshold, so are ineligible under the SSI, but are as similar as possible. Again, nothing happens before and after. They are equally split. So even if we treat different countries from the donor pool, so the treatment is due by the DSSI. The key issue is the IMF program. So you could say that what we see, the decline in spread, is not the DSSI, but simply that these countries are under an IMF program. The IMF program could do better good, and if it's doing good, then you can see spread going down. So here we treat countries which are ineligible under the DSSI, but which sign an IMF emergency financing program, COVID-related, soon after the DSSI announcement. So these 16 countries are non-DSSI eligible countries, but signed an IMF program, and again, nothing happened to the spread whatsoever. So you can infer from here that what you see in the main chart is the DSSI and not the IMF program. Then we do, as I said, other methodologies, synthetic diff in diff. Here you see, like, the blue line is the DSSI eligible countries, the red line is our synthetic control. This is a standard DSSI, standard diff in diff chart. There is nothing, sort of no pre-trend, and then you see that the two lines are separated after the treatment, and here we can actually test that the difference, which is 200 basis points, is statistically significant. And we have here time and country fixed effect. Generalized synthetic control, same thing, confidence band, again, the effect is statistically significant. Final point I want to make in the last minute or so, we want to look at the mechanism. Here, to look at the mechanism, we rely on a standard local projection method. We look at evolution of spread, and the key variable is the interaction between the DSSI eligibility countries and the post-DSSI dummy. We control for past spread, time, and country fixed effects. Here, what we want to do, we'll try to see if there is some differences across countries. Bear in mind that we have 16 countries, so it's very difficult to have something statistically significant. We look at point estimate. First of all, if you believe in the stigma story on the right-hand chart, then if we split the sample between countries which have a lot of exposure to private creditors and a limited exposure to private creditors, should expect that the one who are very much exposed to private creditors, for those countries, spread should actually increase, or at least not decrease as others. Instead, we find that the two samples behave very much the same. So if you believe there's some sort of stigma attached to that, and that countries don't take up because fear retaliation from private creditors, this evidence doesn't seem to support this story. Our story is a story about liquidity provision. So the spread goes down because you get an injection of liquidity. If this is the case, then you should expect the decline in spreads to be larger for countries that benefit more from the DSSI in terms of like savings in their service as a share of GDP. We split the sample in two between those with a large and small size of DSSI relief. And in fact, we see that in terms of point estimate, the effect of the DSSI is larger for those who are receiving larger amount of liquidity injection than for others. Then we do some heterogeneity in terms of initial level of public debt, and we find that the effects are larger for countries that start from weak fiscal position. So to conclude, the question is, can a simple debt moratorium without any haircut imposed to the creditors help countries weather a negative shock? Our answer is yes. Rapid and conditional provision of debt rescheduling. Two countries that are undergoing a short-term liquidity shock can actually be useful because it is financing condition. It could be an effective instrument to provide financial support without imposing costs on creditors. Our results support the design and adoption of, for instance, simple state contingent debt instrument, which has been like advanced by a number of scholars, with some sort of floating grace period already embedded in the program, which can make even kind of avoid the need to go in sort of debt restructuring and simply like help countries mitigating the shock, simply using the state contingent clause that is in the instrument. There are two caveats in the last 10 seconds. One is Our results can generalize to other countries facing short-term crisis, not DSSI specific. At the same time, it doesn't imply that the debt service suspension is the optimal response to COVID-19. If the crisis becomes a solvency crisis, what you need is real debt restructuring and not just debt service suspension. Second of all, we focus on official NPV natural debt relief. What happens to sovereign spread the moment private creditors will join that restructuring, which is exactly what people are discussing right now. It's a question that it's to discuss, and we think we provide a framework to try to answer that question. Thanks a lot.
Thank you very much, Andrea. That's excellent. Okay, so we've got up to half an hour for comments and questions.
Can I make a comment on Bernard's paper?
Certainly, yes. Please go ahead.
You know, as you've seen from my presentation, I'm the empiricist in the session, so I'm not the one best place to like comment on the models. But I think, you know, the model you presented has a lot of, I think it delivers a lot of results. Some of them maybe you didn't mention. At some point in the conclusion, you also said something interesting about the fact that results may be different across sectors. Then you have the results clearly that everything depends on the extent of capital control. And then I assume that your results will differ depending on sort of currency mismatching in firms' balance sheet. That would also be a key. So bottom line, I think you have a lot of prediction. I think there is a lot of potential for you to bring the model to the data. So if I understand correctly, what you're doing so far is simply matching some moments. And I think there are two ways you can reach the paper. One would be the easiest way would be to provide more sort of stylized fact at the beginning that you want to replicate with your model. So you have this initial chart, which is like, but then you can try to say something more, sort of which are some sort of macro trend that you want to replicate with the model. For instance, again, try to identify some shock in the data, and then looks how, let's say, we can split your countries in closed and open in terms of capital account and see what happens to the trade balance, current balance, and all that. And the other thing we said would be, I think there is a lot of implication here that can allow you to go to some sort of micro data. Maybe in one country, some countries even among low-income countries, or even in South Africa is wonderful firm level data that we can use to test your implication. You have, and there's plenty of shock that you can use. So my suggestion were more like directed of like more how to enrich the analysis and expand it.
Thank you, Andrea. Bernard, do you want to respond to those points at the moment? I should remind the panelists that if they want to ask questions, they have to raise their hand because they're not able to. You're not able to type into the Q&A box. So use your raise hand function if you want to say something. But Bernard, do you want to respond in the first instance?
Yes. Okay. Yeah, those are really good suggestions, and I thank you for the comments. And this is my second paper, and in my third paper, actually bringing now the data. I'm doing now the estimations in my third paper, where I have introduced nominal rigidities. And in this case, now I want to see how we can have policy coordination and how fiscal policy fiscal policy, monetary policy, and macroprudential policies, how if I include these three policies to the model, and I now bring the data, I'm yet to see how the model will behave. Yeah, but that's the direction I'm taking in my third paper. For the currency mismatch, yeah, the model can actually test for currency mismatch. What I can do if I have to test for currency mismatch in the balance sheet of the domestic banks is now to take exchange rate as the price of non-tradables relative to tradables. Currently, I am taking exchange rate as the price of tradables relative to non-tradables. But if you want to test the balance sheet mismatch, I can switch and take non-tradables, price of non-tradables to tradables. And such an approach has been taken by Sosha in one of his papers, when you want to test for currency mismatch. But in this case, I'm focusing on exchange rate as price of tradables relative to non-tradables.
Thank you. Can I follow up, Bernard? I'm taking advantage of being chair here to ask a question, but one thing that struck me in your presentation was that when you had these two channels open, yes, the path for output and consumption was invariant. So it didn't matter how open the capital account, how strong the capital account restrictions were in your model. And I was wondering, is that an artifact of the way the model is set up, that it's structured so that, in a sense, there's a kind of a perfect offset or something going on, that if you've got a very open capital account, the absence of other rigidities in the system mean that any change in the composition between tradables and non-tradables is perfectly neutralized, so that the path for aggregate consumption and aggregate output is unaffected. Because that seems to be quite an important result when you look at your welfare implications. That all the action in your final slide on the welfare implications comes when you've got only one of these channels open. And I was struggling to get an intuition of what's going on there.
Yeah, that's interesting. But that's why I said, when you look at the response of current account and output, when we allow the two channels now to interact, yeah, it's true that they are invariant. And this is what I was referring to as the two channels are offsetting each other. Mm-hmm. Because when you look at the financial channel of exchange rate, increase in foreign flows will exert pressure on exchange rate. And then appreciation of the exchange rate will make exports less competitive. That's an example. So that's how the two channels end up offsetting each other. But when I allow the interest rate channel only, you realize that the variables were now responding when we change the degree of financial openness or capital control.
Okay. One suspects that when you try and bring this to the data and add nominal rigidities, you're not going to see this in the data. That feels too flexible in terms of this ability to for resource allocation to switch quite so quickly in response to the degree of openness.
Yeah.
Okay. Any other points that people want to raise on the on Bernard's paper at the moment? If actually, not, sorry, go ahead.
Okay, sorry for interrupting. Actually, I'm estimating that paper, and you are right. I'm already running into problem when I try now to bring in the data, and I'm trying now to interrogate the model further, why this is happening, or what could be the reason behind this kind of problem I'm experiencing now.
Okay. Okay.
Yeah, but any suggestions I really welcome, and I will really appreciate.
Okay. Let me turn to Ignacio's paper And again, I'm going to jump in here because this is something that I worked on a long time ago. I think it's a really nice paper, lots of interesting stuff going on here. But I wanted to focus on some of the stuff that came at the end about the relationship between conditioning aid flows on domestic resource mobilization directly, which is clearly a big part of your paper. Am I right in thinking that you've got a single tax instrument here?
Yes.
Okay, because I suspect there's quite an interesting problem about the distortionary effect of domestic taxation. If you've got taxes that are more or less distortionary, and I'm interested in exploring whether you set up a perverse incentive here for to access finance by moving quickly on more distortionary taxes for revenue mobilization purposes in a way that may undercut growth. For example, it may turn out to be easier to mobilize resources through aggressive profit taxation, for example, as opposed to a broader based value added tax that may be harder to mobilize in the short run. Do you see, is that something that you'd be interested in pursuing within this framework where you might have differentially distorting taxes?
Yeah, that's something that I initially thought about, but I haven't pursued as much, because right now what I want to capture with the tax is just this disincentive to formal labor, right? And that either if suppose in this extension that I was thinking at the end of introducing private capital, if you assume that that is only useful for the formal sector, it's going to be similar if I introduce labor or capital taxes, for example. Probably the effect will be similar. But it is true that, especially in developing countries, many times they have relied on very distortive taxes, right? Like trade taxes, for example.
Yeah.
They're easier to collect because you could go to the harbor or something like that. Yeah, and that's an issue that, especially when you think about why countries do this. I think this idea of taking seriously into account that the government might be self-interested, at least partially. Yeah. That explains why sometimes you make decisions that are not in the best interest of your country, right? And you go to very distortionary taxes. And in that sense, again, I'm saying, okay, think about that kind of taxes. You want to give aid so that you make the government move away from those distortionary taxes. Well, if he's self-interested, he might not change anything, right? He just get more rents or things like that. But yeah, introducing different taxes would, I guess, complicate a little bit the solution by hand, but this could be computed also and extended, and I think that would be a very interesting extension for sure.
Because a lot of some of these initiatives that you've seen, the UK government some time back in their promotion of revenue agencies, independent revenue agencies, was about really addressing kind of exemptions, loopholes, broadening the tax base, trying to push hard on the on mobilizing revenue at the same time as reducing distortions at the margin, and increasingly trying to do that conditionally.
I actually had a question for
yes,
Andrea.
please go ahead.
So I was looking in your main graph, Andrea, that many of the countries, it seems, if I understood it correctly, the dots are the moment where a given country has started or activated the program for himself, right? And it looks like for most of them, the spreads were already falling before getting these debt relief. So I don't know to what extent you have like a selection problem here, in a sense that if a program is designed in a sense that whoever wants can access it, then at the end of the day, only those that are in a relatively good condition, might not need it, are going to take it. But those that do not want to show that they are in problems, they're not going to take it. So at the end, you have this adverse selection problem, I guess, right? Like I was thinking this is similar to the program in the US, for example, during the Great Recession. But the difference is that there they said, okay, everybody has to take it. We don't want to, discourage those that have problems to show them, and only benefit those who actually don't need it. So everybody takes it, and then we solve the problem. So could you tell a little bit about what do you think would be the effect of just imposing everybody on taking it right now?
Yeah, no, I think it's probably my fault. I wasn't clear. What you said at the beginning makes perfect sense. And in fact, what we are doing, we are studying the effect of the program, like on those eligible countries. So the sort of red line, the average decline is for all the countries, irrespective of the fact that they're activated or not. Out of the 16 countries of which we have the data on sovereign spread, at the time of our analysis, so we fixed time in September last year. I guess half of them, so like 7 or 9, something between 7 and 9, already took up the program, and the other did not. But our effect, so our treatment is the eligibility, so it's the program. So we're looking at what's the effect of just granting the possibility of 2 countries to take that suspension on sovereign bond spreads. We could, and exactly because the question is, at least if you go back and read the press at the time, there was a lot of concerns from market participants and rating agencies that were already putting some countries on sort of a negative outlook or something like that, and not really downgrade, simply in anticipation of what could happen if they go and take the DSSI. So for us, it's like, there is this program, does the market react in a negative way simply because you are eligible to get some sort of debt relief? And that's our story. And that said, we also did some analysis. That one is not in the paper, on sort of on the, when the treatment is the time in which you actually signed up. We still see some effect, but it's power becomes even less because we have less countries. But yeah.
Thank you. I'm going to slightly change tack. I've got a question from the audience on Ignacio's paper, and then one that is broadens out the discussion a little bit more to financing, which I'll take, that's relevant to all 3 of you, that I'll take second. So first, can I call on Adrienne, please, to offer her question?
Yeah, hi. Thanks for this very interesting 3 presentations. Chris's question earlier just sparked another thought about the taxation in Ignacio's paper. And I wonder whether your framework can account or should account for taxes levied on the foreign aid itself. There's sort of an ongoing debate whether donors should be exempt from, or whether foreign aid should be exempt from domestic taxation. Often donors are granted exemptions from import taxes and VAT. And these donors are also some of the biggest spenders in those economies. They're building roads and bridges and these kinds of things and employing lots of people. And so if you're exempting their spending from tax, you're losing a large or potentially large source of revenue. Yeah, I just wondered whether you had any thoughts, Ignacio, on how that might interact with the other kind of tax and aid relationship that your paper brings out.
Well, I had never thought about it. Thank you for the question. I'm not sure if what you're talking about applies more to something like foreign direct investment and things like that, right? I don't know.
No, it's usually donors, like, for example, the spending of former DFID, now FCDO, in a country like Uganda would be, if they had project financing, like building a road, would be exempt from the import taxes on their inputs, for instance. And that would be contained in the tax code as like statutory instruments. It's not necessarily some kind of waiver only applied to that project. It might be more institutionalized than that.
Okay, yeah, I'll certainly look at it. Right now, within the framework I have, it wouldn't make, I guess, a huge difference, because at the end of the day, you can think of just the donors want to give 100, or yeah, they want to build this project, irrespective of if they're paying tax or not, they're gonna just, it's gonna cost more. Like if there was a 0-1 decision, maybe like I do it or not, maybe that would tilt the decision towards one side or the other. As of now, it's not something that I have, I don't think will make any change. But I have to certainly think about it, because I had never, thought about it or actually heard about it. So it's, thank you very much for the comment. Yeah.
Yeah, no problem. There's a, if you want to be pointed in the direction of a small research that looks at this, ODI have a paper, I can't remember who wrote it. I can try and find it and email it to you. But they have a paper about the taxation of foreign aid, and it might be in just sort of the history of it. It might be interesting as a starting point to think about this.
Yeah, thank you very much. That would be wonderful. Yeah, thank you.
I think it's a nice issue. I think there's, in terms of your model, Ignacio, I think there's probably a distinction if the aid flowed in as essentially budget support, just augmenting the resource envelope of the state, and then the state went out and purchased imports for public investment, then indeed the aid would be, or the spending out of the aid would be taxed. I think Adrian's case is a special one, almost a direct delivery of public investment. So FCDO rocks up and says, we will build you the road, and we will hire the contractors on tax-exempt contracts. We will import the goods on tax-exempt contracts. And in some cases, especially, there is a link here, because in some cases where you're dealing with low trust environments, where donors are acting to keep resource flows outside the budget, then you're more likely to encounter this situation that Adrian is talking about, where it's almost as if there's a parallel government that is donor funded and is doing the implementation. Somewhere like South Sudan would be a classic example of that, that kind of model occurring, where public service delivery funded outside the budget by donors who then enjoy tax-free, domestic tax-free importation and so forth. We're coming close to the end of this session. We've got about 9 minutes left. I've got one final question. I wanted to ask Alan Harding to pose this. Now, this is his question, I believe, is somewhat broader, not into the mechanics of the papers that are presented, but it touches on this broader issue about external financing adjustment, and in particular, adjustment in the context of the COVID crisis. So Alan, can I ask you to present your question? And you can target it to whoever you want, or to all three.
Chris, thanks very much. Can you hear me?
Yes, you're a little bit faint.
Okay, is that any better?
Yes, that's good.
Maybe I'll speak up. Chris, thanks very much, and apologies to the speakers. I'm afraid I've only just joined the session, so I did actually miss the presentations. As Chris will know, I actually worked at DFID for several years, so a very interesting question, previous question on the issue of tax exemption for aid donors, and I think I probably had some experience of that myself. But anyway, my question was about the sort of response or donor response at the moment to obviously the effects of the pandemic on particularly on low-income countries who are obviously facing all kinds of budgetary management and fiscal problems at the moment. And there's a bit of a discussion at the moment, obviously, about the relative merits of providing further types of debt relief to those countries. And obviously, you know, countries like Zambia, Mozambique, in some cases, countries that have had a history of receiving, you know, debt relief through the HIPC initiatives and other initiatives over the years, versus, and obviously, debt relief as a way to allow them to use whatever resources they've got instead of paying for debt relief to maintain sort of priority expenditures, whether it's on health or in other areas. But it's the relative merits of debt relief versus possibly coming up with a new type of budget support. So I was very much involved in some of the early sort of thinking about budget support programs, and it's kind of gone out of fashion, particularly amongst bilateral donors, although the European Union and the World Bank do still provide sort of types of budget support. I'm just wondering if anybody has any thoughts about what the relative merits or advantages, disadvantages would be in terms of how do you help low-income countries through to respond to the fiscal shock that's come about as a result of the pandemic. Should it be debt relief or budget support, or a combination of the two? Thank you.
Can I suggest that we'll put Andrea on the spot first, because I know his result is primarily about the value of liquidity support through debt relief. So your thoughts, and then maybe Bernard and Ignacio would like to add something. Yeah,
no, it's true. Like, the analysis we have done was simply to see if liquidity, if debt postponement, so the sort of the first response of the international community could have provide some benefits. And I guess the answer is yes, but it's sort of limited in the sense that it's difficult from them to generalize to the response to the COVID shock, and the fact that there is a DSSI #2 and maybe #3, and the fact that there is a discussion for a new framework to deal with sovereign debt already says that the DSSI was not sufficient. I think our point is that it's more general, and the fact that most of these countries oftentimes face liquidity shock, negative liquidity shock, not necessarily solvency shock, and while COVID is probably a solvency shock, then very simple instrument that already embeds some sort of clause for like grace period that you can activate. It should be like a way to go in the sense a bit more. There's a lot of discussion about innovative debt instruments, GDP index debt, and all that stuff, and there is very little in practice. And I think that our results speaks to the fact that we should have more of those instruments, especially because, and that probably answers partly your question. There is a key element of the response should be the sort of the speed at which you respond, and we know that restructuring takes a lot of time. And if you read the IMF and the World Bank webpage, they praise themselves on how fast they've been in answering and responding to the crisis. And from a sort of a borrower perspective, they say it took time. So. And now I guess all the discussion for a new sovereign debt restructure will take even more time. And I studied a lot the HIPIC and MDRI, and even that case took a lot of time. It was a never-ending cycle. And here it seems again, DSSI 1, 2, 3, 4, 5, 6. So I guess the risk is that the risk of debt relief is that it's always incremental. So either you come up with some big debt stock relief at the very beginning, but then it's very difficult to get creditors at the table. Here it's more difficult than in the past. We have private creditors, there is China, there is emerging donors, so it's very complicated. So I guess maybe in theory, in the books, like debt relief, like stock debt relief could be the right way to approach the problem now, because you can solve COVID shock on top of some other debt problems in the past, and you have an exogenous shock which you didn't have at the time of HIPIC MDRI, so it's easier to sell politically. Mm-hmm. On the practical side, given creditor coordination issues, maybe instead like budget support, as you were mentioning, it could be more viable. I'll stop it here too.
Thank you, Andrea. So 1 minute, Bernard, 1 minute, Ignacio, and then I'm afraid I've got to wrap up because the CSAE conference waits for no man or woman. Bernard, do you have anything you want to add in this last, in response to this last question?
Okay, thank you. This is not really my area, but I also feel that debt relief is the way to go for now for these developing economies, because some of them are already running into debt distress, and they already have high external debts. So offering some kind of debt relief, either through restructuring or writing off some of the debts, I think is the way to go for now, given the COVID impact on these economies. Yeah.
Okay, thank you, Bernard. Ignacio, any final thoughts, observations from you?
Yeah, in this sense, my point would only be that at the end of the day, there is a short run, long run problem here. Like I think, for a very temporary shock or something, or potentially a temporary shock like COVID or something, maybe the relief might be faster. But what Andrea is saying is clearly also another point, that maybe putting the donors in the table and doing the relief process is going to take too much. But at the end of the day, when you think about the long run, periodic debt relief programs might not solve the deep problem of domestic revenue mobilization. You have to do some other kind of policies. That would be my point.
Yeah, thank you. I think that's a really good point to end the discussion on. So thank you all very much for participating today. My apologies to any of you who've posted questions that we've just run out of time to address. That's frustrating on the one hand, but encouraging on the other, that there's plenty of discussion around these issues. So first of all, let me thank Andrea, Ignacio, and Bernard for their contribution to this session. But just as I'm closing, let me also remind all of you, panelists as well as participants, that we have 2 more macro sessions this afternoon. The first one starts in 30 minutes at 2 o'clock UK time on structural transformation. And then at the end of the day, starting at 4 o'clock, we look back to issues of taxation and tax administration. That final session has more of a focus on sort of using micro and administrative data. But it nicely bookends where we started today with Ignacio's paper. So thank you all very much. It was a pleasure to have you at the session, and enjoy the break. I may see some of you again later this afternoon. Thanks a lot.